I want to tell you something about a conversation that happens in my office more than any other. Someone comes in, usually in their late 50s or early 60s. They've done everything right. They have saved consistently for 30 years. They have a solid mix of investments. And then we start looking at the details. And I have to tell them something that their previous advisor never told them. You've been paying taxes you never needed to pay, not because of bad investments, not because of bad timing, but because the right investments were sitting in the wrong accounts for years, sometimes decades. There's a strategy called asset location. Most investors have never heard of it. And it might be the most important thing that no one's ever told you about your retirement accounts. I'm Stuart Dickson with HD Money. 18 years in this industry, hundreds of real families, every kind of market, every kind of situation. Asset location is one of those strategies that sounds technical, but once I explain it, you're going to wonder why nobody ever walked you through it before. Let's get into it. First, let me make sure we're clear on one distinction, because these two terms sound almost identical. Asset allocation is what most people know. It's the mix of investments you own. How much in stocks, how much in bonds, how much in cash. That's allocation. The what? Asset location is completely different. It's about where those investments live, which accounts hold which investments. That's location, the where. And here's what most people don't realize. The same investment held in the wrong account can cost you thousands of dollars a year in taxes you never needed to pay. The investments didn't change. The account it was sitting in changed everything. To understand asset location, you need to understand three types of accounts that most people have in retirement. Bucket number one is your taxable brokerage account. This is money you've already paid taxes on. And every year you hold investments in here, dividends and interest get taxed as ordinary income. If you sell and have gains, you pay capital gains tax. Bucket number two is your tax deferred accounts, your traditional IRAs, your 401k. Money goes in before taxes. It grows without being taxed every year. And when you take it out in retirement, every dollar gets taxed as ordinary income. Bucket number three is your tax exempt accounts, your Roth IRA, your Roth 401k. Money goes in after taxes. It grows completely tax-free. And when you take it out in retirement, you pay zero taxes, not a dime. Three buckets, three completely different tax treatments. And most people treat them all the same. They put the same mix of investments in every single account without ever asking, should this investment be in this account? Quick note, if this is useful, hit subscribe. New video every week. This is exactly the kind of thing that we cover. Now, here's where it gets really interesting. Here's the core of the strategy. Different investments generate income differently, and that affects which accounts that they should belong in. Bonds generate interest income. That interest is taxed as ordinary income, which for most of my clients is 22 to 24, sometimes 32%. If your bonds are sitting in your taxable brokerage account, you're paying that tax bill every single year. But if those same bonds are sitting inside your traditional IRA, that interest isn't taxed annually. It compounds, it's tax deferred, you only pay when you withdraw, and often at a lower rate. That single move, moving bonds from taxable accounts into tax deferred accounts, can be worth thousands of dollars a year for the rest of your retirement. Now, flip it. Your high growth investments, your stocks, your equity funds, the things that you expect to grow the most, those belong in your Roth. Because in a Roth, that growth is completely tax-free forever. You're not just deferring taxes on that growth, you're eliminating them entirely. So think about what that means. If you have a stock fund that doubles over 15 years inside your Roth, every dollar of that gain is yours. The IRS gets nothing. But if that same fund is sitting in your traditional IRA, when you go to pull it out in retirement, you're paying ordinary income tax on every dollar of growth. Same fund, same return, completely different tax bill because of where it lived. That's asset location working exactly the way it should. Let me put it into real numbers on this so it stops feeling abstract. Research from Charles Schwab shows that a retired couple with a $2 million portfolio can potentially reduce their annual tax drag by anywhere from $2,800 to $8,200 a year just by placing their investments in the right accounts. Same investments, same total amount, just located more strategically. Over a 20-year retirement, that's potentially over $100,000 in taxes that you didn't have to pay. That's not a rounding error. That's real money. So why doesn't everyone do this? Well, here's what I've seen in 18 years. Most people get their investment accounts set up in pieces. The 401k comes from work. The IRA was opened by a different advisor. The brokerage account was something that they set up on their own. No one ever looked at all three together and asked, is this the right stuff in the right place? That's the question that asset location answers. And it's one of the first things that we look at when a new client comes to HD Money. Because before we can talk about what you own, we need to talk about where you own it. Here's a simple framework to take with you. Tax inefficient investments, bonds, high yield dividend funds, actively managed funds, they belong in your tax deferred accounts. Your traditional IRAs, your 401k, let them grow without the annual tax drag. High growth investments, stocks, equity funds, the things that you expect to grow the most over time, they belong in your Roth. Let that growth happen completely tax free. Tax efficient investments, index funds, ETFs, municipal bonds are fine in your taxable brokerage account because they don't generate as much taxable income. Right investments, right accounts, that's the whole strategy. But most people spend decades building a portfolio without anyone ever asking whether the right things are in the right places. It's not about what you own, it's about where you own it. And getting that right could be worth more to your retirement than almost any other investment decision that you ever make. That's what 18 years in this work has taught me. And it's why I keep showing up here every week, putting the same conversations I have with clients right here for free. If you want to know whether your investments are in the right accounts, the link to the HD Money Retirement Fit Quiz is down in the description. Takes about 2 minutes. And hey, if this was helpful, subscribe so that you can catch next week's video. I'll see you there.